this could be S&P 10,000 by 2027. If they're making 330 a share, put it on 30 times earnings. It's going to be very painful if you're an active manager and you're waiting the whole time for the next 3 years for 1999 to happen. My message is energy is the thing that will pop this bubble. If you have oil prices go to 150 or 200, inflation gets out of control, and the Fed's having to reverse course, raise rates, that will be a major problem for the market. But I don't think we have that now. The Fed cutting rates right now, when the Atlanta Fed GDP estimates almost 4%, and we're going to be
4.0%, yeah.
Right, and we're going to cut rates into this. This is going to be a boom. This is like pouring gas on the fire.
I'm joined at Erik at YWR. That is Your Weekend Reading on Substack, a very, very interesting publication, an experienced investor and analyst. Erik, thanks for joining us. Welcome to Monetary Matters.
Jack, thank you.
Erik, how are you thinking about the markets and the economy right now?
I think we're in a massive boom, particularly in the US. But if you look at the IMF for GDP forecasts and how they've been revising them up, they're revising GDP up across every region of the world. Japan, Europe, the US, the Middle East. It's across the board. And I think it continues. I think the market keeps going up higher. And I think my message that when I'm speaking to a lot of other fund managers and high net worth investors, private family offices, the disconnect I am seeing is that I think people are kind of think that maybe we're at the end of something, worried that the market's at the risk. The risk is to the downside. The market's expensive. This is similar to 1999. All this AI spend is malinvestment. It's maybe great long term, but there could be a nasty correction in the very short term, similar to how we all got excited about the internet in 99. But a lot of this high-speed fiber build-out, WorldCom type stuff, Global Crossing, a lot of them see analogies to that. And where I am seeing basically a longer-term growth, I think there's extra kickers still to come, that this keeps going through 2030. Start thinking the S&P can get a lot more expensive than it is, and we could be going to 10,000. And I think people need to use a bit more imagination that this is actually going higher. And when you look at the Merrill Lynch survey, I always look for the extremes. I mean, I think we've all been kicked in the face by the market so many times that often that I kind of look for what would be the surprise, right? And the surprise would either be a big recession or that this keeps going. The one outcome that people are not expecting is either a big recession or a boom. The most consensus outlook right now is stagflation. And so I'm actually in the camp that people's outlook for the economy is too low, and we're going to continue to grow at a high rate, and the market goes higher. And I think there's a global boom happening. And I just increasingly from portfolio managers I talk to and people in chat groups that I'm with, it's like they're always waiting that this is 1999 and it's time to take a bit of risk off. The market's expensive. And I think I want to say that this market can get a lot more expensive, and not even mathematically. It's with this kind of consistent earnings growth and these bond yields, actually, I mean, you could with Gordon growth model, you could say this could be the PE of the S&P could be 30 times, and mathematically it wouldn't be. It would kind of make sense with this kind of interest rates and this combination of growth. So I think these people are being lazy about this whole it's 20 times. Like, where does that come from? On what basis is 20 times expensive given for the last 25 years, the S&P has been averaging over 7% EPS growth a year, and it's going to do 10% this year and 13% next. So I'm just I think and also, who says 1999 has to be the greatest bubble ever of all time? Let's use some imagination. Maybe we're going to have an even bigger one. But anyways, that's what I'm just going to say. I think when you look at the survey, nobody thinks the economy can boom. Everyone's in this stagflationary camp. It's why gold is doing well. It's why Bitcoin. Everyone wants the kind of dollars weakening, but no real growth, right? They don't want actually to bet on the economy picking up, which is, I think, I think we're going to have a 4% GDP number in the Q3. Or I mean, that's what the Atlanta Fed estimate is. But anyways, that's my message to most people I'm talking to, like on the fund management side, is stop fading it. It's actually going to go on longer than you think. And I'm actually like, I think retail, I don't know, maybe they're just bumbling along, but they seem to be the smart money here, and they're actively participating in this. And I just feel like the institutions are just really fading it. And I don't know. It's just that would be. I think people need to use some imagination. That this is another thing. Another big thing, Jack, is so I was used to cover banks, and I'm just feeding. I don't know why. Just giving you, because I know you got so many. I'm just trying to give you the backstory of my view. But banks have been in a kind of in a regulatory doghouse since the GFC, right? There was Basel 2 and 3, tier 1 regular capital requirements were raised. Banks, especially in Europe and Japan, have not been lending really since 2010. Balance sheets have been flat while the banks kind of have been stacking up capital and kind of deleveraging through growing the equity base, keeping the balance sheet flat. US banks have been growing a little bit more, but not much. And I'm like, we now have, with higher bank profitability is really improved, especially in Europe and Japan. Like with the worst thing was the 0% rates. Like it's really hard to make money as a bank when with rates negative or zero. And now there's a bit of spread. Japanese bank ROEs are bounding up. They're reinvesting in higher and higher bond yields all the time. European banks have improved a lot. They're buying back shares. They have tons of capital. I'm like, what if the banks start to like get their animal spirits back, and regulators, like the mood from the top is no longer like, oh, don't ever lend again. It's like, oh no, now you can lend. Now we want growth. Now Europe's got to pick up. We got to figure out how we're going to grow. Japan's like, we got to grow. So I'm like, the next, we have this massive CapEx boom going on. China's
Massive.
right. China's recovering, and I'm like, everyone's like, okay, but that could just be about to fall over. And I'm like, maybe, but we also have another kicker, is we have the banking system hasn't even begun to join this party, especially in the US, sorry, in Europe and Japan, where there's tons of excess capital they could be deploying now at a profitable rate. So I'm like, I think this could be S&P 10,000 by 2027. If they're making 330 a share, put it on 30 times earnings. Anyway, so I'm like, anyways, that's my, I think it's, that's maybe something different than what everyone, you might be a
It
little.
is. I think you're more bullish than a lot of people, but maybe there are too many bulls. So you think people are too bearish, particularly institutional fund managers are too
Oh,
bearish.
yes, yes. Institutional fund managers are bearish. They are just, they think the market is expensive. They are obviously looking at the CapEx there. They would take the other side of this AI CapEx and just say, oh, it's malinvestment. It's going to have no returns. This is like broadband fiber, like high speed fiber and the internet. This is going to be a mess. And you think, and the underpinning of the whole market are these mega tech stocks, right? And while they might have been expensive before, now, I mean, at least they had tons of free cash flow. Now they're kind of maybe more expensive. That's case by case, but basically they've become free on a free cash flow basis, you know, much less interesting than they were
Because they've
before.
been investing so much. So investing a ton doesn't immediately detract from net income profits, but it does detract from free cash flow immediately. So
Right. So they're like, oh, well, now I would never, Meta is going to have a net debt, or, these companies had tons of free cash flow, but now they're on a frenzy and they're just trying to one up each other and going crazy, like Oracle building data centers. And this is the final end with no, and I get that, but I'm also like, a lot of things they have done. I have been wrong about these companies for a long time. And I've been wrong about Mark Zuckerberg. I thought he was an idiot when he bought Instagram. I thought he was an idiot when he bought WhatsApp. And I'm like, maybe these guys do this job better than global value investors or whoever, you and I we talk to. I'm like,
yeah,
we're
probably
not.
a lot of the people who are critiquing Mark Zuckerberg now, they or investing so much money in AI and data centers, they probably, like you, thought it was a bad idea to buy Instagram.
Oh, remember he had just IPO'd, and I think he spent he spent a lot of money on WhatsApp, and I don't remember. I mean, both those transactions, I go, oh look, this is exactly what is the risk of Facebook. This guy has no sense of, you're giving him the keys to the car, you give him an IPO, and he's just spending and doing stupid acquisitions, and that's why this thing's going to flop. And I look back and I'm like, these were some of the smartest things ever. And so I'm careful myself that these are some of the wealthiest people in the world. They have been in this game for a very long time, and have created monopolies, moats, and businesses beyond our wildest dreams. So let's give them some credit, maybe, that they know how to do this better than we do. I
Yeah,
mean, that's so. And also, by the way, I'm using this stuff all the time. I mean,
me
I
too.
think we're
I'm
all
using
addicted
increasingly.
to it, right? I mean, it's
Yeah.
definitely hooking us in.
What's powering this boom? Later on, maybe I'll ask you, bring up the various counter arguments of bearish arguments, and have you kind of swat them down for us. But just in the positive sense, what is powering this global economic boom? What is powering this bull market?
Multiple layers. Let's start with the governments. Most governments are spending more now. I mean, it's not extremely bad. I mean, but think back to post GFC. Europe was always we're always worried that we were going to have the next shoe to drop was going to be a blowout in sovereign bond yields. There was the pigs crisis in early, I think it was 2010 or 11. So there was always concern about fiscal deficits. And we've kind of gone into this other, after the Ukraine war, we governments are spending now, kind of like 6% deficits. It used to be 3 was a big deficit. Now we're kind of comfortable running 5 to 6. So on the governments are spending money. Corporate CapEx has really picked up, and it's kind of across the board. It's AI, it's data centers, it's chips, a lot in defense. Aerospace is doing well, grid build out, LNG exports, renewable energy, batteries. It's kind of like a lot of things going on. And when you looked at it, like there's industrial companies like Eaton, and they look across, they've never seen so many different parts of their business actually doing well at the same time. So there's tremendous amount of just on the ground capex. And what I like is that it's actually in a lot of these data centers are in like Ohio, Louisiana, Abilene, Texas. I mean, this is kind of money getting spent on the ground across the board in the US. I was looking at a memory chip company in South Korea that are I think they're SK Hynix.
Yeah,
They're,
yeah.
they're spending 3.5 billion on a chip packaging company in Indiana somewhere. So I mean,
Mhm.
this just money is coming in from around the world. So this is the capex story. Another story, which I don't think it hasn't been a factor yet, but I'll just put it in the like ammo, or the next bullet, the banking system. And this is something I used to be a banks analyst on the buy side, so a global banks analyst. So this is another shoe to drop potentially. Banks have been, as we know, went through a big regulatory crunch after the GFC. When I first started, the regulatory requirement was the tier one ratio required was 4%. That was the
That's
that was the lowest, right? I mean, that was the BIS number, but of
yeah.
course you would have like 5 or 6 to not be the bare minimum, right?
Mhm.
After the GFC, that kind of went to 10, 10, depending if you're a globally significant bank, right? Then if you're a really big bank, it kind of went to 12.
Yeah, and this is the leverage ratio. So if you have a ratio of 20, then you're leveraged 5 to 1. If you have a ratio of 10, you're leveraged 10 to 1. And
Yeah,
if your leverage,
it,
if the leverage ratio is 4, that's very low. You're leveraged 25 to 1.
right. And there's a wrinkle to this in that it's risk weighted assets.
Mhm.
So sovereign, your local government bonds don't count in against that ratio. So actually, the leverage ratio could be much higher. But
Yeah.
just to say yes, broadly speaking, the leverage ratios have been declining. Banks have been deleveraging since the post GFC. You think about that. It's like the central banks were trying to push on the gas with 0% interest rates, but your biggest money multiplier, which was the banking system, was deleveraging the whole time. In Europe, they were just, the balance sheets were flat, but they were stacking up retaining earnings, just retain earnings and slow, because they did the amount of capital they had to get to, it was just so much. They did some rights issues, but the other way they did it was just a slow grind over years, building up those tier one ratios to now where they're
And the
at
share prices were down big time. So
big
even though
time. Big time. Oh, this is, I mean, it was terrible. It was banks deleveraging, so no growth in the income in the balance sheet. Plus, net interest margins were collapsing because you had negative 50 or 75 basis points in Germany, kind of negative 50 basis points across Europe. It is very hard to carve out a net interest margin when rates are negative. So banks were hurting, and for a little while there were a couple years where there were non-performing loans that got sorted out by, like, I'd say 2016, 17. But basically, no negative rates, regulators on them. We don't want you to lend. Don't do that again. Get the one BIS ratio at one new BIS rule after another, and regulators all fighting the last war. And then around after COVID, this all started to flip completely the other way. Interest rates jumped up across the board. In Japan, they're still happening, but Europe, the US, now all of a sudden the banks could start to could make a lot more margin, and they had excess capital. They didn't. I was like, okay, so I was like, okay, they were making more money than they've ever made before, but they were still bearish. This was early 2023, 2024. So what's happened with European banks and is happening kind of now with Japanese, massive share buybacks because they weren't bullish yet. So they're like, what do we do with all this money? We don't know if we want to lend it. Let's just give it back. And their share prices were depressed. So they were giving money back. What I'm saying now is, I mean, and this is again an anticipating prediction, that I'm interested if the banks start to get their animal spirits back. And I'm like, if these banks now, they're making great profits, they've been buying back shares. Also, the share prices are much higher now. So it's not as, the math doesn't, it's not as accretive to buy back the shares now as it was 2 years ago. So I'm like, wouldn't it be interesting now if, and it actually may start with the US banks, you know, is there some kind of national top down directive or pressure like, hey, we have a national reindustrialization going on here. Why don't it's requiring a lot of capital. Why don't the banks get involved here as well in the US? And so I'm just saying, as I look at this this bullish picture I'm painting, whereas, I think a lot of investors are looking at those CapEx numbers and waiting for the second derivative. When does that all fall over? I'm saying there could be the banking system hasn't even begun to lend yet, and that could be the next kind of pass the baton on to the banks for in terms of loan growth starting to come through finally.
Yeah, I know in the US, credit card loan growth has been very, very abundant since 2020, I think, but a lot of other categories have really not, and particularly mortgages. So you think like all of this economic growth has happened without the banks really stepping up their loan growth, other than US credit card banks. And yeah, so tell us also about just like where you think we are with the AI CapEx cycle, because you mentioned all these bullish factors. You mentioned like seven of them, but I think three or four of them were very connected. So you said AI, data centers, chips, and energy. And to me, you could make the argument that maybe those are two trades and maybe even one trade, because the data centers is what power AI, chips are what are in the data centers, and they all need energy. So is this all just one big trade? And is this undoubtedly AI CapEx boom that's going on right now? How concerned are you about it's going to be a bust? I mean, is the answer never, in 3 years, or tomorrow? And where are you on that spectrum?
I think it's more across the board, the capex. It's not. I mean, it is related, that the data centers, the chips, but it's LNG liquefaction plants down in the south. It's aerospace. It's defense. It's the EVs, still like battery plants. I I think it's more than just AI driving this. Another piece is the consumer has been kind of deleveraging since the GFC. We haven't seen much growth in mortgages. The credit card, I haven't the credit card data to me does not look that high. I mean, maybe there's been some since 2000, but overall consumer lending has been quite modest. Consumer balance sheets are, I think the consumer's in a pretty good spot. That when you look around the world, the American consumer is the most exposed to financial assets. We are have the highest home ownership ratio, most amount of exposure to equities, either through people's own brokerage accounts, between 401ks. It is amazing. The American consumer has really benefited from the rise of financial assets, and it's really been something that I see in Europe and Japan. They just kind of miss out on these things, and I think, you probably do have too. I have a lot of friends that are made. I grew up in Montana, and I'm like surprised how well they've done and how much the money they're making. So I'm unemployment's low, wage growth is we're getting above inflationary wage growth of 4%. Consumer hasn't even levered up here either. So I think that I think there's more legs to it than just the Oracle data center build out. So, or just data centers in general. I think this can keep going.
But isn't the huge, oh my god, I've never seen this before in my entire life, growth in data center? I mean, individual companies are not spending $100 billion for one company on, LNG liquefaction, right?
Yeah,
It really is. The data center is the front and
the
center.
data center numbers are the most overwhelming thing. Yes,
Yeah. What are your observations? What are your observations there?
I think when isn't it? Don't we have 2 or 3 years more of this to go? And so
Yeah.
I mean, I'm just my view is out to 2027, 2028. I'm just like, I think there's enough visibility here that the economy is very strong right now, and at least for the next 2 years, it's probably going to continue to be so. And there's extra kickers that can come in on the banking sector. So, and globally, China's picking up. I mean, I'm actually more interested in the emerging markets right now than I am in the US, but I just don't think the US is about to fall over. I mean, because a lot of people may be interested in the other markets as well, but they know that if the US is going to crash, then that could end up ruining the party for every other market as well. But so I'm just more that I think the US can do well, it can go higher, and you know what? It's not going to spoil the party for the rest of the world.
Hmm.
On the other side, the same way we haven't talked about the banks leveraging, the strong dollar has been really a headwind for emerging markets. I, you know, spent a lot of time investing in Africa, so I'm very this strong dollar we've had for the last, since 2015, 2016. The commodity bear market, strong dollar has meant, you know, central banks around the world, in Latin America, in Africa, have had to have very high interest rates to, if you're trying to if you're a central banker in the emerging markets trying to contain inflation while your currency is deflating, they had to raise rates. Interest rates in Egypt are 25%. In Nigeria, they're 20%. In Brazil, what are they? 12%. So you've had central banks around the emerging markets have had to fight this dollar with raising very high interest rates locally. Imagine what happens if we get a little bit of dollar weakness, which is kind of what I think is going to happen. And we've had it this year, but I think this is going to be a bit of a multi-year trend of not a crash, but just slight dollar weakness. If that starts to turn into a tailwind, if the Brazilian real starts to appreciate, the Korean won, the Mexican peso, all these, Egyptian pound, the Turkish lira, for if that even happens, right? They all of a sudden they can start to they wait for a while. They're like, oh, is this really happening? Inflation's falling, our currency's stable. Maybe we can cut rates. And this emerging markets are highly when interest rates fall in emerging markets, they're very, it's very intensive growth, right? It's very energy intensive growth, commodity intensive growth. You give a Norwegian an extra $5,000. He may, I don't know, it may not be much of a multiplier on that, but an extra $5,000 in the South America, in Africa, in Turkey, in Indonesia. It's an extra air conditioner. It might be an extra scooter. It could big ramifications to industrial commodities, energy, and just overall consumption. So I think this is another piece is any slight weakness in the dollar, you're going to have a big feed through into emerging markets. And if you look at the emerging markets indices this year, I think South Korea is up 80%, Brazil is up like 40 or 50, I think China is up 30, South Africa is up 50%. So these markets have had a huge boom this year, and everyone's like, oh, could it continue? And so I think, wow, I mean, I know the valuations of these markets are still quite low. So on valuation basis, they're still a lot cheaper than the US. We get another, and this is another part of the growth story, right? Like emerging markets coming up, South America growing, the Middle East growing, China growing. China's growing 5% GDP. China is, by the way, is coming off this is the second biggest economy in the world. They're coming off their version of the financial crisis. They had an enormous property crash. They're coming out of that. No one thought they were going to do 5% GDP growth this year. It looks like they are. The industrial sector is booming. The technology, I was just over in Hong Kong last week. We went over the border to Shenzhen. It's shocking. I don't know. I'm amazed at what the car companies are doing. I'm amazed the robotics, Tencent, the software. China is really amazing on technology. So this is just to say another part of the growth is it's also not even just the U.S. anymore. I think where we've had a great year, we had a pretty good year for EM, definitely a great year in the stock market, but I think we have more to come on that too. So that's part of also why I call it a global boom. I'm like, it's happening everywhere.
So you're bullish on stocks, you're bullish on emerging market stocks in particular, you're bullish on global economy, but in particular, you're bullish on China. You mentioned a comparison you've made between China right now in 2025 and the US in 2010. So we could put that on screen from the YWR.world universe. Actually, the chart is from GovCall Research. So
Yeah.
shout out to them.
Shout
But
out to
just
Lewis. Yeah.
just make this comparison because this aligns with my thinking, and I think it's very compelling.
Oh, I mean, don't we wish we could all go back in time to 2010 and remember when we were worried about the double dip and that it wasn't over and we were all so tentative. But at the time, you had low valuations in the S&P, you had low interest rates, there was low inflation, so the central banks could be aggressive, the government was fiscal stimulus was aggressive. And actually, in hindsight, the market was going to rebound for years. And now here we are in China. They've just had a financial crash. I think fiscal stimulus is almost 8-9% of GDP right now. Interest rates are 1.7%. Do you want to know? Isn't it kind of amazing that it's classified as an emerging market, but has some of the lowest interest rates in the world right now?
Yeah.
And I think the average PE is like 13 or 14 with a 1.7% 10-year.
Yeah, I mean, obviously, if you're a bank or institutional investors have to own bonds and stuff, but like if you're a Chinese yuan denominated investor and you're like overweight bonds over stocks, like what are you doing?
And what I also love is some people will say to me, they go, Eric, I'm never going to invest in China. And I go, you know what? Nobody cares because the Chinese have so much money, they can run this bull market all by themselves. They have so much savings. If they want to allocate it from bonds into equities, you should just get on board if you want, but there's enough savings in China to run this market a long way. And the government also, this is kind of a national imperative or not. I mean, I say that because they don't come out and say it explicitly, but they do support there's quite a lot of times where the market would sell off and the government would come in and request the pension funds to support the market, which is a pretty clear statement of they want the market to go up. So, and also it makes sense, they had a lot of problems with overinflated property and a lot of social issues, right? It was always great for one generation, but difficult for the next generation to ever get on board the property ladder. And they're very sensitive to that. And that's why I think equities make sense. It helps reflate the economy. It has a wealth effect, but it doesn't, hurt your standard of. It doesn't hurt your ability to live like the property market did. And so, the Chinese really promoted property for over a decade. It was one of the biggest bull markets in the entire real estate world, and now they're promoting equities. And China is one of the cheapest markets in the world, one of the highest savings rates. They're coming off like a property crash. I'm like, this is like we're getting a second bite at the apple, and we should definitely get involved.
Yeah, and just to read that GovCal research comparison, when it comes to comparing China now to the USA in 2010, the cost of energy lowest in the world, cost of labor very cheap, cost of capital lowest in the world, currencies undervalued. The prevalent belief in the USA in 2010 was that following the mortgage bust, the US would experience a lost decade of low returns. Now the prevalent belief for China in 2025 is that given its balance sheet recession, Chinese growth is going to disappoint. So it seems like there is that is an apt comparison. Eric, I happen to be a bull on Chinese equities myself.
Okay.
I will say that I'm fine with the situation, but I do think it is true that Chinese involvement in equities is not at all like it is if U.S. involvement in equities in terms of individual investors. And like, do you really think that there is going to be kind of a speculative bull market in stocks, just like there was it in real estate? Because like for example, I won't even name it, but like there's a company I've been involved with, and literally they had so much money compared to their market cap and everything, and they chose to buy a building with it. I'm like, you should buy back 40% of your capital, of your equity. But that, I think it's a cultural difference. It is there. Do you acknowledge that?
Oh yeah, they don't do share buybacks yet as we would like.
A lot of them
The
do. That is increasing though. That is increasing.
It is increasing, and Europe's doing it more too. But I just met some companies last week that was our guidance to them was they should be buying back shares rather than, and they were, anyways, they weren't into that. But I did, Jack. I think back to 2007. I was at a hedge fund, and I saw Hong Kong go crazy. We owned Hong Kong Exchange. The volumes were through the roof. The IPOs, all the derivatives and the options trading. It was a madhouse. And I've seen it myself, but also I've spoken to the kind of older brokers that were around for, I think I'm trying to think, it was 95, 96. There was another great bull market, previous bull market in Hong Kong. But you know, it can really go. Chinese have definitely can get FOMO. They can take risk. They have savings. I've seen it already, in my career, and I think it's going to happen again. And so all the elements are there for this. I think the Hong Kong stock market has not made a new high yet. It's been kind of bouncing around. I think we're going to make much higher. We're going to make all-time highs in this Hong Kong stock market by a lot. I think we're really in like the second or third inning of this. This is going to go a lot more. And Jack, you made it that, speaking of that GavCal slide, it reminded me of another point I wanted to make about the market just in the US. It's I was going back and looking at the top in 1999 and the top in 2007, and in both cases you had the Fed raising interest rates, and you had kind of a move up in energy prices. The the energy price went from 14 to 30 in 1999. It seems low, but it had I think been around 20. Then it kind of dropped during the Asia crisis in 98. But then, with the Fed raising rates and the internet boom, oil did make a new high to $30. So you had that combination of rising rates, expensive energy. It's what we had in 2007. Fed raising rates. Actually, that was more like into 2006 was the Fed raising rates, but energy got to $130. And I'm like looking at it now, and you kind of think back, you're like, oh, if something were to pop a bubble, that would be a good 1-2 punch, right?
2022 oil price, yeah.
Or yes, so I'm like, okay, we have the Fed cutting rates, and we have the oil at kind of on a not an inflation adjusted basis like an all time low, but $60 oil. these aren't big problems, right? The consumer's fine, the consumer's employed, CapEx is through the roof, government's spending money, bond market's not giving anybody any problem, Fed's cutting rates, oil prices are low. Like, where's the big, like, what's the real problem here? Other than you think 20 times is expensive, but the, EPS is growing, earnings are growing 10% this year, 13% next. So I think that's my message is energy is the thing that will pop this bubble. If you have oil prices go to 150 or 200, inflation gets out of control, and the Fed's having to, you know, reverse course, raise rates, that will be a major problem for the market. But I don't think we have that now. That's why I'm like, the Fed, the Fed cutting rates right now, when I think the Atlanta Fed GDP estimate's almost 4%, and we're
It is
going to
4
be
4.0%. Yeah.
right, and we're going to cut rates into this.
Yeah, and
This is like a freaking
I interviewed a
gas.
Fed governor. I just interviewed a Fed governor who said he wants to cut it to like, below 3%. So
This is going to be a boom. This is like pouring gas on the fire. So, yes, somewhere down the road, they're going to have to reverse course and the bond market will probably react to it. But right now, you have massive GDP getting revised up, earnings doing fine, CapEx through the roof across the sector, the global economy picking up, China picking up, emerging markets benefiting, and the Fed cutting rates. It's like it doesn't get any better than this. It's insane. So we should be like massively long, right? I'm like 1% cash right now.
yeah, I have made this chart and looked at this chart so many times, but it's crazy. I didn't know that the price of oil from 1999 to 2000 basically doubled. That is crazy. How in the history of the dot-com bursting
I
is that
know
ever really talked about?
it's never
Because
comes up,
everyone
right?
knows that in 2008 price of oil went 140 whatever.
Yeah, I
But
remember. Yes,
yeah,
I think because it looked back and it just doesn't seem. But I was looking for that. I was like, oh, was there that? Was it part of the recipe of the top? And it it was kind. I mean, it was there. There was this rise in the oil price there to a new high to $30, and so I go, oh, because I think that could be the surprise. Everyone's looking for the black swan event. I'm like, is the black swan that we've been telling the entire energy industry there's going to be no growth in energy? I mean, here's another, kind of macro thing, Jack. I If we think back to the last commodity boom back in 2003, 2004, and I was at a hedge fund at the time, and I sat next to the commodity guy, and so I was kind of very lived this day by day. What Why did that happen? In hindsight 2020, we were coming out of a recession in the US in 2001, 2002. Growth expectations were low, and the commodities had been in a bear market for over a decade. And so no one expected a bull market in commodities. Nobody what surprised the world was 1 billion Chinese breakthrough $2,000 GDP per capita. They come out of this kind of subsistence poor income levels, start to have discretionary income. They're buying an air conditioner. They're buying a scooter for the first time. They're starting to maybe travel. This was a surge in commodity intensive growth from a billion people with a commodity sector which didn't expect it. And at the time I was working, so that was China came on the scene, and it went on for years. In hindsight, we go, oh, that's what started the bull market in commodities. We are now, India is now at $3,000 GDP per capita. If you look back and you adjust, China was around 2000 back then in 2020, in 2004 dollars. Basically, India is right now where China was in 2004.
and it's
They're
been growing incredibly quickly.
incredibly quickly, but now their GDP is high enough that I think they're at that same threshold where China was. Like, they're another 1.3 billion people are coming on the scene into very energy intensive growth, and where nobody's talking about it. I'm like, okay, India's having their China. It took them a while. There was back. I remember, at the time we were also bullish about India, but India was in hindsight was too poor. China was in the sweet spot at that time. India's in the sweet spot now. So here we are. We've
Although
told
Indian
you,
equities have performed really well.
yeah, the equities have. I'm talking more commodities and
Yeah.
GDP. And
Yeah, no,
one of
I had noticed that obviously Indian GDP has grown so much, but looking at India, like oil consumption and CO2 emissions and electricity consumption, it hasn't been parabolic that much.
no,
But
oil's
yeah,
been pretty steady there. I mean, it's been, I think they're just under, I think 5.5 million barrels per day. I think they're around there. But we're at that point. It could actually start to accelerate because we're at that point where China was in 2004. And you just put the picture all together. We've told the energy industry that there's going to be no demand growth, right? We're going to go to zero oil consumption by 2040, 2050. And I'm like, what if that story is the complete opposite? That actually we have another billion people about to go through a very intensive energy spurt, and they're going to want energy. Meanwhile, China is recovering. The US, I think our oil demand actually hit a new all time high as well. I mean, we always talk about shale, but I think the US has had a bit of growth as well. What if we're underestimating this entire thing? And I'll say one other thing. We've been oil discoveries have been at all-time lows. The amount of time it's taking to bring on new projects is at all-time highs. The structure of the oil supply is increasingly from shale, which is a very highly, quick depletion type of resource. The surprise in the market may not be private credit. It may be that we actually underinvested in energy, and higher energy prices could be the surprise of that, and eventually derails this market. But we're not there at all yet. But I'm like, if you want to think of something totally different,
yeah.
that could be the problem. Is maybe we pitched a whole case of not needing energy, but actually it's the complete opposite. We need a lot of energy, and we're going to have to scramble to find some, drill it, and bring it online, and it's offshore, and we maybe are topping out in shale, and we have a very interesting energy story on our hands.
And this is why you write at YWR that what could prick this bubble or prick this bull market is $200 oil, and yeah, that
Yeah,
certainly would prick this bull market.
I'm like,
Eric,
yeah.
so you're an optimist on oil demand. What if I were to throw some optimism on oil supply at you, particularly in the U.S.? Like Eric, I've heard for 3 years that the Permian production is peaking, and it just continues to go up and up and up. Like, isn't there's a lot of oil, particularly in the Permian Basin. Like
Well,
the doomsday calls up, the Permian Basin has just grown so much, and I don't know
yeah,
why can't it continue.
yeah. But the Permian Basin has been amazing, and I agree. And also, it's defied expectations of it kind of rolling over despite a very low rig count. So
Yeah.
drilling efficiencies have been amazing. But the what's kind of poking holes in this thing is you look at the different shale plays around the U.S. The Niobrara, the Bakken, the Haynesville. A lot of them have flatlined, and it is the Permian. And I just, you kind of sit there, and around the world, there's just kind of become this comfort that the U.S. is this unlimited tap of easy to bring on oil. And I'm like, that whole story is now down to one area of Texas. All those other ones have flatlined and are slightly declining. And the amount of growth in the Permian has actually become quite minimal right now. It's like, I think it's grown an extra 200,000 barrels, but it's really, I'd say it's flatlining for sure. We're not getting the explosive gains that we were getting, like adding 1 million to 1.5 million barrels a year. So it's, and I mean, eventually the rig count is at the lowest ever. So I'm like, I don't know. You're right. It has surprised, but the legs are starting to, we're getting down to, it just is the Permian. So anyways, I think that could be I'm not as, it looks a lot more mixed to me right now than it did before.
What does?
The supply story,
Oh,
and also it's very, shale. We forget that shale is a high. It depletes quite quickly. You have to run pretty hard to maintain that I think 13 million barrels per day in the U.S. So let's just see. It also could deplete quite quickly. I mean, we might have, let's see, but it's down to the Permian. And gas is, gas production in the U.S. is flatlined. Some months it's negative year over year. Oil has been okay, but that's the big story in the world has been U.S. shale, and it looks like it's kind of becoming a one-man band about the Permian. So
Eric, tell me about this chart, this pinned tweet you have on X about the gross leverage of long short hedge funds, and it shows that they are quite high. They're very leveraged. Seemingly, that would have nothing to do with energy and our previous conversation topic, but does it? How does it?
the antidote I have from kind of fund to fund investors is that a lot of shorts in the energy sector. And I'm just interested. I mean, I'm just interested in that chart shows that net exposure of the hedge funds is not that high, which kind of fits our what we said earlier in the podcast that institutions are not that bullish, right? So it's a little bit above average, but what's really high is the gross exposure. So it makes you wonder, what are they so short? Where is all this gross exposure? It's always a mix of things, but I would suspect that a lot of that short is in the energy space. When you look at the Merrill Lynch Fund Manager Survey and you look at what sectors, where sectors are they overweight, where are investors underweight, energy is one of the top sectors that people are underweight. Also, you look at implied volatility. Implied volatility for oil is very low. Another kind of telltale sign that there's been shorting in the energy space. So my suspicion is that hedge funds, some of that gross exposure is shorting the energy sector. I mean, and I
Yeah,
hear also another anecdote is you starting to hear calls for $50 oil, $55 oil, things people never would have said. But now when the chart looks like it does, that people kind of extrapolate this on to the next, that it's going to go a lot lower.
yeah. Eric. So I'd say a core thesis running through everything we've talking about is that global growth estimates are way too low, and that there's going to be a global boom in economic boom that's going to power a stock market boom that few are expecting, and many people are still way too positioned on the bearish side.
Yeah, or maybe it's just the persistence of it. I mean, it's just if you keep growing. I mean, it's pretty boomy right now. I don't know if the second derivative is going to accelerate even more, but just if you keep doing this 10, 13% EPS growth, and if you start to get a little bit of capitulation and institutional investors having to get on board with this, we could have a lot more of a move in the market. So yeah, my message is I don't. And actually, when you look at a chart of the S&P relative to earnings, it's kind of like just the S&P. Is a bit of multiple expansion, but it's pretty much just been grinding along with the EPS. It doesn't look like an out of line parabolic move relative to earnings. It just
Depends what
looks
chart you're looking at, but yeah, it is. There has been a lot of multiple expansion, tons of earnings growth. You're right, and you show how S&P per share, in 2019 was 163, 2020 went down to 140, then 2021 208, 2022 219, 2023 220, no growth. Then now it's going to be like 243, and things are looking so good now that maybe this year 270 for 2025, and for 2026
300
maybe
next
304.
year,
You said 330. Slap a 3.
330.
Yeah.
Yeah, 330 for 2027, right? So 300 next year, 2026, 330 for
Yeah.
2027. What if we're going to 30 times earnings? And I mean, what in the 99, what will we get? Were we like 40, 50 times earnings on lots of stocks? So I'm just, so maybe we get to 8,000. I'm trying to
Yeah.
open people's minds to where this is going. That if the growth is maintained, if the economy is actually okay, and there's underpinnings to this, and there's next legs to this, and we're going to go to 330 on the S&P EPS, and we get a bit more of a multiple expansion, you're going to be getting into the 9-10,000 on the S&P, and that's going to be a tremendous move that you are going to. It's going to be very painful if you're an active manager and you're waiting the whole time for the next 3 years for 1999 to happen. Everyone has imagination to the downside, and I'm trying to interject a little bit of imagination to the upside. And you have a Fed that's going to cut rates, as you are actually probably more aware of than anyone else. I think you just had an interview with one of them, one of the Fed governors. But yeah, you're going to have Fed cutting rates into all this. So I think it's quite positive. Jack, one thing I'll just throw in here at the risk of going on another tangent, but I'm just I'm careful with EPS estimates because what one of the mistakes I got wrong about a stock I have missed for most of my life has been Amazon. And lately, Amazon has shown a lot of earnings growth. But for a long time, Amazon was growing revenues at like 20% a year, but showing no profits. And it's something I think the tech sector is increasingly doing is focusing on top line growth and reinvesting everything into growth at the expense of showing EPS. And I think there is an increasing constituency of venture capital investors and retail investors which are all right with that. Think back to when Berkshire Hathaway started, right? It was kind of think if you were an MBA back then, what was the value of a stock? It was the it was the net present value of the dividends of the company, right? That was the value of a company. So what happens if a guy named Warren Buffett comes along and says, guys, I am never going to pay you a dividend ever because it's actually not tax efficient. The second I pay you a dividend, you got to pay it to the government, and there's leakage, and then you take that dividend, you reinvest it in Berkshire Hathaway shares. But why we lost a good chunk of that dividend to as you have to recognize income, and so you ended up a tax bill. I'm going to do you a favor. I'm not even going to pay you that dividend. I'm just going to reinvest that profit back into Berkshire Hathaway, and you'll make it up in the share price. So that was kind of an innovation in terms of corporate finance, right? Or stock valuation, a company that never pays a dividend ever. Wow. And we all got around with that. We all kind of like, oh no, it's cool, it's fine, it doesn't matter. There's a book value, and it's the values accruing, and all these companies, and we'll just value it another way. It's all right that it doesn't ever pay as a dividend. Now I go to Amazon, and I said, you know what? It's different because I don't think Amazon can say this. But what if Amazon goes around in September of every year and goes, that's they sit down with the CFO and they go, how much net profit do we have? Oh, we're going to make $300 million or $1 billion. You know what? Let's go through our list of initiatives. Let's grow Amazon Prime. Let's greenlight 5 more movies. Let's do another couple of warehouses in the Midwest or something. Let's spend that money, because what's the next iteration of that is, let's not show any profits, because if the second we show a profit, we have to pay it to the government. So let's just reinvest it into growth, and let's hope the investor sees that. And I'm like, the difference with Warren Buffett is he can say, I'm not paying a dividend. It's not
Yeah.
tax evasion. That what Amazon could be doing is kind of like, oh, you're kind of actually, that's almost like you're gaming the system and you're doing tax avoidance. You're deliberately spending money to not have a profit so that you can grow the company and not have to pay tax. Because,
Yeah.
right? So I'm just
Yeah.
what I'm taking this to the next step. I'm going, we all focus on the S&P's EPS and putting a 20 on it or a 30 on this E number. And what I'm saying is, what if the biggest companies in the entire market are playing games, and actually we assume that companies are trying to maximize the E. That's the whole game, is to maximize profits. And I'm saying, what if the game is shifting and actually companies are trying to maximize revenue growth and minimize E so they don't have to pay any taxes on it? What does that do to the whole story? I know it's another weird tangent, but I'm just like, reasons that we might be undervaluing the S&P is, what if this E is actually suppressed, not maximized?
Oh,
You know?
I mean, you're right. Warren Buffett, yeah, did pay a dividend. I know, 100 years ago, all stocks basically paid dividends, or
Right?
that was the expectation. With it, it worked out for Amazon, and I think that's great. And they did reinvest so much in their business, and the reason they didn't have a profit is because their depreciation expense was so high. So their cash from operations was positive for for like over 20 years, I think. But their net income, their profit was very very low. So if you looked at AMZN ticker, what's the PE ratio? It would appear like it was 300 or something.
Yeah. But also
I
even the
understand that,
cash
but Eric, I
was
feel like, okay, so you're a smart, disciplined investor who's also experienced. So this view that you have, I think it won't do you that much harm. I think that if someone's not a very experienced investor, like, they could take this thing of like companies don't need to have profits and just kind of lose a lot of money.
no, no, no.
I think in 2020, sorry, 2021 and 2022, that was the philosophy you just described run amok, and all of these like venture capital horrible companies that like would never ever make a dollar of profit kind of were just dumped on investors. So I see what you're saying, and yeah, I think you have to identify the wheat from the chaff, and that's why investing is so hard.
Oh, I totally agree. And I'm not trying to say that every fraud that doesn't make money. I'm just trying to get my head around, maybe Tesla, right? Like they're so aggressive on growth projects, and we got to do robo taxis, and we got to do robots. I mean, what could the earnings be? We got to do in a
Yeah,
semi truck, and they're trying to do everything at once. You're like, okay, well, what would the earnings be if you weren't? And that was you said on Amazon. Actually, the cash flows, they were better than the earnings, but they weren't. You can't tease out of the expenses what's growth and what's run of the, like, if it's so intertwined that actually that's a very hard analysis to do. Everyone wanted to know what is the underlying cash flow of just the retail online retail business. They don't tell you that.
yes,
There's so many stocks right going on right now with quantum computing that are, you know, I don't know the space, but it looks speculative, right? But
speculative.
so yeah, but I was just meant more of a kind of this kind of transition to how venture capital guys work, where they're much more focused on growth and establishing your market position, get out, grow faster, just gain market share. We'll worry about the profits much later. And I feel like that venture capital guys are very comfortable with that, not showing earnings for long periods of time while companies are trying to establish new position, grow new products. And I feel like some of that is coming into how public companies are acting. And I just say, bringing it back to that PE ratio, which so many people are hanging their hats on, that's the problem with the market. Is if you ask someone, do you like the S&P? Do you think these are good companies? Are these great businesses? And they would go, without a doubt. Microsoft, I use it at Global Monopoly, I use it all day. JP Morgan, Facebook, Amazon, Nvidia, love, I have no problems with how they're managed, think they're fantastic businesses, love their global dominators. What's their problem? I just think they're expensive. And I'm going, let's rethink that. Everyone, if you ask anyone across the board, they always say it's expensive. And I'm like, okay, let's think about the earnings growth. Does it make sense
Yeah.
relative to bond yields? Are the companies possibly suppressing earnings at the expense of growth? Like, let's dig into this more, because the surprise might be that actually they're not as expensive as we think. And maybe that's where the market multiple is going to expand. And if you look, another thing, if you look at the earnings of the S&P, aside from COVID, they've been relatively there's not much variance to the earnings. The earnings have been kind of stable from the S&P. So you go, actually, the Sharpe ratio on these earnings are pretty good. And another thing I dug into, I was looking at how the business models have changed. And what you look is a lot of companies have gone to service revenues or subscription. There's been this
Yeah.
huge move to subscriptions. Apple earnings, they're growing the Apple. Microsoft is like 70% subscription. And I went back like 10 years, 15 years, and I looked at Morgan Stanley now is way more about asset management, recurring revenues versus trading. And I think all of these companies have got it in their head to like go to these recurring, high PE, more stable revenue models. And so it shows up in the S&P that earnings are actually quite steadily growing. There isn't a whole lot of volatility to it. And I'm like, you know what? Net net, that should get a higher PE. So,
Yes.
anyways,
Yeah, and I mean, we talked about this huge boom in construction, and like construction is obviously very, very cyclical. Like a software business that is profitable and very predictable, deserves a higher multiple than like a construction company or a coal company. And like, yeah, software businesses are a very, very high profit, good business model. That's why they can get away with giving so much money away in stock based compensation and stuff. But yeah, I think that there are a lot of high quality companies in there are a lot of high quality publicly listed U.S. companies for sure.
yeah, and I think everyone likes them. They're just like, I don't know, they're not cheap, and yeah, and I'm not sure they're going to get cheap.
Yeah,
Some of
and
the
you
best
say that
money.
as an experienced investor all around the world, including America, Europe, emerging markets. Eric, great to have you on Monetary Matters. Tell us about YWR, your weekend reading. What kind of stuff do you write and post, and what kind of audience do you have?
Thanks, Jack. I post twice a week, and I really try to focus on non-consensus views on things. And it's a mix. Sometimes I talk about economic stuff. Sometimes I talk about individual stock picks, industries. We do a lot of data analysis. I try not to have it just be my views. We do a lot of screening of stocks around the world, what industries are, where estimate revisions going up, where valuations attractive. So we do a lot of data analysis and trying to help us come up with new themes that no one's talking about, and also try to always try to think differently, because that's usually where the money is made, and trying to be creative about things. So yeah, your weekend reading. So check it out.
Yeah,
Thank you.
I really like it, and I think people who come from more institutional background will
Oh
definitely find
yeah, I would
it.
say it's skewed towards. I find when I meet people, I try to meet as many of my readers in real life, like, for coffees or beer, and I often find they work in the industry. Yeah,
Thanks everyone for watching. Please like and subscribe on the Monetary Matters YouTube channel and leave a rating and review on Apple Podcasts and Spotify. It really helps the show.
thank you, Jack.
Thank you. Just close the door.